You've probably heard that life insurance is the wealth building tool of the wealthy or some other marketing slogan like that. Let me show you why that's not the case. Permanent life insurance works in that you pay for the policy's premiums, and then any additional money that you pay goes into the policy's cash value. The cash value is like a savings account attached to the insurance policy. The savings account can grow in a couple of different ways, and when you want to withdraw the money is taxed as income. Most people get around this by using the policy's loan provisions, since loans aren't seen as income, therefore they're not taxable. But here are a couple of issues that people usually gloss over with these policies. Number one is that insurance premiums can seriously limit the return on your money. Since permanent life insurance is so dang expensive, the amount of money that's actually going to that savings account at the end of the day is going to take a big hit. Number two is that the growth of the cash value will almost always be outpaced by more traditional investments. The exception to this is variable policies, and there is something to be said for the consistency of returns that you might see in insurance policy. However, stability over a long period of time isn't really that important if you're losing out on a bunch of opportunity costs. Again, the policy is going to grow a little bit slower than most traditional investments, and that's not including the hit on insurance premiums that we just talked about. Finally is the complexity. There is almost nothing about permanent life insurance that's simple. That doesn't mean that it's bad. In fact, I actually think it's a great tool if you already have some wealth that you would like to preserve. But adding unnecessary complications to a financial plan is almost never a good idea. So there had better be a darn good justification for muddying the waters with a 60+ page life insurance contract.